So, good morning, good afternoon, and good evening, everybody. My name is Sam Wong, and this is a session on Founder's Guide to Safe Startup Fundraising. I've done the session maybe about 10 or 11 times starting in 2021. However, this is a session with an update for a lot of 2025, 2026 content. There's a lot of new content in this version of the presentation. So, hopefully, buckle up. It's going to be a lot of stuff to cover. Fundamentally, one of the things we do tell founders is don't blindly sign a safe. Okay, if you're fundraising, there are a lot of nuances about a safe that can really be a surprise. And then what we're trying to do here in this session is help you to be able to understand the nuances so that you can make informed decisions about how you want to fundraise for your startup. Okay, so it's confusing. And if you look back at the history, there's actually multiple versions of the safe. And most people don't even know that. Okay, the original version was released by Y Combinator in 2013. That was not they didn't assign a version number to that. And then over time, they started releasing version 1.0, 1.1, 1.2, and there's actually even a quiet release of version 1.3 that most people are not even aware of. Okay, so there's actually been 5 different revisions of the safe templates from Y Combinator. What we're trying to do with this session here is really emphasize what we believe to be one of the most important things that founders need to do, and that's to learn. We always talk about founders needing to be able to emphasize and invest in their learning because it's startups are hard and most of the concepts are very, very difficult to be able to master. So the more that you can invest in learning, the more that you'll execute well. Okay. The challenge is that, in my experience, most startup training is too basic. It's pretty fundamental, it's pretty simplistic type of content. Startup concepts, as I mentioned earlier, they're hard. Okay. So, how do you deal with some of these challenges if they are indeed hard? What we've tried to do with our offerings at my company is rapid expert learning. And if you've been in other of my sessions, you know I'm a movie fan. One of my favorite movies is The Matrix. And if you have seen the movie, there's a scene where the main character, Neo, is able to learn martial arts in instantaneously through the technology that they have. And he just wakes up a moment and says, I know Kung Fu. Okay, it's just a great scene to me because I wish I knew Kung Fu. But anyway, my name's Sam, and I run a company called Fundable Startups. Way of background, I've done 5 startups. The first 2 of them shut down. Thankfully, startups number 3, 4, and 5 were all acquired. I also was an advisor for 2 other companies that got acquired as well. I do a lot of speaking. I've spoken at TechCrunch Disrupt twice. I've spoken at the Lean Startup Conference, been quoted in magazines. I also volunteer and spend a lot of time with some startup accelerators. Okay. In my company, Fundable Startups, we offer self-paced training. We also have a live training academy. So it's some of the same content, but and delivered in a live format. We do one-on-one coaching, and I also help with fundraisers that usually involves building pitch decks and helping with investor outreach. Okay. It's a do it yourself, done with you, or done for you type of situation. I also spend a lot of time playing a number of different roles. Okay. I don't only do content, I don't only do training. In fact, I probably only spend 20% of my time or less on some of the content and training. So I work as an instructor and a coach. I also wrote a book on startup execution. And most of my time is spent being a fractional founder. I typically play chief business officer, chief financial officer, and sometimes play a CTO or CPO role. I'm actually a software engineer, backend developer by training. Okay. And the rest of my time is spent as an investor with Band of Angels. Okay. So today's agenda. All right. We are going to talk real quick about funding strategy because it's important to be able to have a little bit of context on where the safe comes into play. We're also going to talk about safe history, the rationale behind safes, and the trends in the current trends in the industry. We're going to differentiate between pre-money and post-money safes. Most people don't know the difference. And then we're going to touch on basic safe conversion math. A safe, as if you've been trying to raise funds, hopefully you understand that a safe is a contract to get equity at some point in the future. Okay. Then we'll touch on safes and how they affect startup cap tables. talk about briefly cap table management options with a focus on Carta. I am a Carta partner as well. Then we'll touch bases on some safe variants. There's a lot of other content that we don't have time for. This full course is about 2.5 hours long. Okay. And then we'll end with a summary, talk about some resources and a special offer. So we do encourage you to stay towards the end to be able to see to get the offer. As I mentioned, we're only going to cover probably about 30% of the class. We just don't have time to cover the entire content because it's just too much detail. And I do apologize in advance. If you've been to some of my training, you know that I cover a lot of detail. This class is one of the most difficult to keep up with. Okay. So if you're dual tracking and trying to multitask, that may be hard to absorb everything. I'll do everything I can to explain things clearly, but if you need some follow-up sessions, some follow-up conversations, I'll try to make myself available for some coaching sessions if you need. Okay. We do talk about a lot of detail in this session because your startup, I use this analogy from time to time, your startup is kind of like this truck. And if you're going down the road, the details can be a small pile of nails. If you hit that pile of nails, your best hope is you just get a flat tire. The worst situation is that truck will crash. And if that crash is bad enough, that truck will no longer be drivable. Your startup will probably die. Okay. That can happen and it has happened multiple times, which is one of the reasons why I wrote the book on startup execution, because in my view, execution wins the day. Okay. Disclaimer, unfortunately, I do have to cover this. We are going to cover a lot of content, but none of this content should be construed as legal, tax, or financial advice. You need to contact a qualified professional who understands your situation. There's a lot of information and a lot of educational content here. So we're going to start by talking about funding strategy, and this is just a quick high-level overview. We generally encourage that anytime you're doing anything important, strategic planning really delivers better outcomes. So most people take a random, hey, I'll just work on the most urgent or the most important thing today, and that usually results in, missing the mark. A strategic process, anything important should be planned out because that increases the chance that you'll actually hit your target. Okay. So that also applies to fundraising. We do encourage people to build out a fundraising strategy. Well, what is it? Okay. Well, we define a fundraising strategy. We break it down into four different components. The approach, which answers three questions. When should you raise? Why should you raise your funds this way? And how much should you raise? The second component is sources. From where, what pool of funds or what pool of investors should you what pool of funders should you raise funds from? Vehicles, or what type of contracts should you use? And then finally, targets. Once you've determined who your funding sources may be, exactly which investor or investors would you target? This session is going to dive deep into the funding vehicle, specifically the SAFE, Simple Agreement for Future Equity, which is a contract offered by Y Combinator. We do cover a lot of detail because we've seen lots of founders make common and costly fundraising mistakes. One is not raising enough money. Of course, if you run out of money, then you'll have to raise money in distress. And anybody who's raised money before in the past knows that when you're in a crunch, that's the worst time to be able to raise money because you're going to get taken advantage of. It's also a problem if you raise too much money too early. You may wonder, how could that be a problem? Isn't that a good thing? It can be a good thing in that you'll have a longer runway, but what that means if you've raised too much money too early is that you raise money at a lower valuation, which means you're going to over dilute yourself. Okay. Between not raising enough money and raising too much money, I suppose you'd prefer to raise too much money, but that does have a backside bite, which is over dilution for the founders and the employees. You can also raise money with poor terms. Most people never consider the terms because they don't understand it. Okay. Many seasoned investors actually advise it may be better to raise money at a lower valuation and get better founder friendly terms. Okay. It can be a very, very important deal. And if you are not very fundable and don't build a fundraising strategy well, you might raise money from the wrong investors. Long-term stock exchange, LTSE, had done a survey on how many founders regret taking money from one of their investors, and 28%, I think, 29%, somewhere around there, said yes, they raised money from somebody that they wish they never had taken the money from. These four mistakes result in several painful outcomes. One is a smaller upside. You get your startup proceeds will probably be smaller. You may lose control of your startup faster, and operationally, you're going to run into all sorts of challenges and problems. Okay. These outcomes usually are not visible for 1 to 5 years somewhere in the future. Okay. So, in terms of the fundraising approach, the anchor of the fundraising strategy is when should you raise funds? This slide shows the company's valuation growth over time. It is not a smooth curve. It is a stair step. And that stair step is anchored by inflection points. An inflection point is a measurable milestone that dramatically increases your value. Okay, so the inflection points here would be the red diamonds on the chart, and you should raise money right after you hit an inflection point. Okay. I don't have time to get into the details about how to be able to do this and what types of inflection points to be able to target, but I only have time to cover the actual outcome. So if you raise funds strategically, the right amount at the right time from the right parties, how is that going to potentially play out? So if we have a fictitious company with a specific growth path, okay, and this particular company studies and understands what their inflection points are, they go ahead and raise the right amount at the right time. And by doing so, they get great terms. Let's assume, for the sake of illustration, this company gets an early acquisition offer for $40 million dollars and they accept it. Okay. So that's great. Contrast that with a company that does not build a funding strategy. So they raise too much money in their first round in a convertible note. That convertible note does not get them to the second inflection point, which means they have to raise a bridge round to be able to, cover the expenses until they can actually raise the next round. The seed round ended up being more than they actually needed, so they over diluted themselves. This company has the exact same growth path, but the fundraising is all messed up. Okay. And if that company gets the exact same $40 million acquisition offer, they will actually walk away with a lot less money. Well, how much less? On the left side, raising funds strategically with a funding strategy, in this scenario, the employees and founders keep 31 million of the $40 million acquisition. But on the right side, without the funding strategy, and you can break down all the math, if you are a glutton for punishment, the employees only keep 8.8 million. Most of the funds in $40 million acquisition goes to the investors. So that is a difference in payout of 3.5x. It can be very, very material. The detail about a funding strategy is covered in my funding strategy class. Okay. What I've covered here and given to you is about 2% of the funding strategy class. And if you are interested, this is a little bit more detail. I'll paste it into the chat window. Um, the uh, the details about, sorry, let me go ahead. This is where you can find some detail about the funding strategy class itself. Okay, so let's move on because we got a lot more information to cover still. All right. Okay, so let's talk about safes, history, rationale, trends. All right. Let's make sure that we understand what a safe is and how we got here. Okay. So most startup investors, a company has two types of equity, common stock and preferred stock. Common stock is held by founders. It is not held by investors. It's very uncommon. It's pretty rare to use common stock as a fundraising instrument because investors want preferred stock. It gives them additional rights and privileges. Well, um, traditionally, many businesses, small businesses, are raise funds through a loan. Okay, either you borrow money from a friend, from family, or if you're far enough along, maybe a bank. Okay. The loan has a loan amount and an interest rate and a maturity date. Okay. The challenge is in a startup environment, very few investors and almost no banks will lend money to a startup because the risk is just so high that the investor will probably not get their money back. So loans are not very common. Okay. And if most investors want preferred stock because that's where the big upside is, how do you fix this problem? Well, the concept of converting a loan into stock was created in the form of a conversion feature. Okay. And this is the definition of a convertible note. Okay. So whatever the balance, you get a convertible note today, 2 years from now, there's a triggering event that converts it into stock. The value of the loan balance, the principal plus any interest accrued, gets treated as if it was a purchase of the stock at that point in the future. Okay, so there may be a discount that gives slightly more favorable terms and other things like a valuation cap to improve the math on how much equity that the lender or the holder of the convertible note would get because they took an early risk on the startup. And that's reasonably common. The convertible notes happened very often in the early 2000s in startup fundraising. Okay. Well, there's a problem with convertible notes, and what if the startup can't pay back a loan? Because it starts off as a loan, okay? And if there's nothing that converts the loan into stock, then what happens is that the lender can foreclose on the note, okay? And that means they can sell assets of your startup in order to raise funds to recoup the balance of whatever is owed. They have undue leverage on the startup and the founders. So to solve that problem, the concept was, well, let's just not make it a loan anymore. And that's how a SAFE was created. A SAFE is a contractual agreement to take an investment amount. There's just no obligation to pay it back. There's no interest. But a SAFE also converts into preferred stock at some point in the future, just like a convertible note. So convertible notes, SAFEs, and preferred stock are the most common ways to be able to raise funds today. So if you compare a convertible note against a SAFE, convertible note is a little bit more of an old school instrument, and SAFE is generally viewed as a modern startup fundraising vehicle. The convertible note, when they do get signed, they tend to be larger dollar amounts, where the median SAFE amount is around 20 to 25K. Used to be a bit smaller, 15K or so was the median, but SAFEs are starting to be used for much larger transactions. Convertible notes, the funding is usually done with a smaller number of notes. You usually don't have dozens and dozens of convertible notes signed, but in the SAFE space, you might have, 20, 25 SAFEs signed. That is not unusual. Okay. Convertible notes are typically used for early stage startups, but they can also be used for mature startups. SAFEs are less common as startups start to mature. Okay. And then convertible notes also have that auto conversion, have an auto conversion feature, whereas SAFEs, there is no auto conversion feature. All right. Okay. Here. Excuse me. So I do want to mention Peter Walker. Peter is a senior director over at Carta, and he has the reputation as Carta's data storyteller. Carta is a cap table management platform. And I encourage you to follow Peter on LinkedIn. He has lots of fantastic posts, including this one here, where he delivers some stats from their analytics because they manage so many startup cap tables. In this specific post, he cites how safes and convertible notes have the safe and convertible note usage has gone up 3.8x in about 4 years' time. Okay, so it is very, very much where most startup fundraising, especially smaller deals, smaller raise amounts, are trending towards safes and convertible notes. Well, there's another stat from Carta where if you dig into the details, it's really almost all safes. 93% of pre-seed fundraising through convertible instruments was on safes, and only 7% was on convertible notes. So you can see very, very clearly where the trend is going. Okay. But if this is up where all the startups are going and doing a lot of safes, et cetera, what does it lead to when the company is finally doing a seed round? Okay. Well, if you do, again, Carta-based data, 80% of seed rounds are still done on convertible instruments. Okay. 20% are done on a priced round with preferred equity. Okay. So the median amount raised was about 2 million, roughly, okay, as of the seed round. But this is where the metric came from, the 20 to 26 notes and safes so far. Okay, that's a lot of convertible instruments and contracts to sign. Okay, but Peter also has another post where he basically states too many convertibles can completely wreck the next round's math. Okay. Sadly, most people have no idea what this means. Okay. Peter says this is such a big deal. His comment is, give me a good standard priced equity round any day. Later in the session, I'll talk a little bit about some options on how to be able to implement Peter's advice here. So I've been talking a lot, but I would love to be able to get some feedback from some folks. How much dilution do you think comes from a safe round? Okay, so feel free to drop in your thoughts, your guess. What percentage of dilution of the startup's equity will get diluted when you raise a round of a bunch of safes? Okay, love to be able to see thoughts. Don't be shy. I haven't seen anybody make any guesses just yet. Okay. All right. 15 to 20%. That's not a bad guess. 10 to 20%, 20%. Okay. 8%, etc. You're not that far off. Okay. Um, so the answer is it really depends on the size of the safe round, which I guess is kind of obvious. So smaller rounds are at the top of this chart, larger rounds are at the bottom. I typically, see rounds more towards the middle of this chart. So if you're raising between 500,000 and $1 million, Carta says the median dilution amount is 13.6%. Okay. But because safe rounds are getting larger and larger, the next tier up, 1 million to 2.5 million raise, the dilution jumps to 19.4% for the median. All right. But that's kind of the mean, midpoint, whatever, median. Um, but if you look at the 75th percentile, there are startups that suffered 28 to 31% dilution. So the range can be pretty small. It can be as low as single digits. It can get as high as 30%. That's a huge variance. And sadly, most founders have no idea how much dilution comes when they sign safes. They're just so happy to get people to raise funds that they go ahead and sign them anyway without any detail about how much they're going to get diluted. Okay. And we'll get into that a little bit more in a couple of slides here. Okay. So pre-money versus post-money safes. This is where it's going to get a little bit complicated in a moment, but before getting into the difference between a pre-money and a post-money safe, we need to offer up a definition. Valuation, okay? Valuation of funding. Fundraising is fundamentally selling part of your business. You're selling your company's stock, okay? So whether you sell 10, 15, 20%, whatever percentage, you're selling part of your business. So what does that mean? Let's use an illustration. Let's assume you have a very small business. You are a delivery company and right now you have 3 delivery vans. Okay. You want to grow and expand, but you don't have the funds right now to just buy your own van. So you solicit an investor. That investor says, okay, fine, here's some cash. We're gonna help you buy another van, and then you have 4 delivery vans. So your business is a little bit bigger, able to scale more. Okay. On the left side, the state of the business before the investment comes in, the left side, that's your pre-money valuation. The amount invested, you've added to the pre-money valuation. That equals your post-money valuation. Not too hard. Okay, so conceptually, if you are a startup, maybe your business, you negotiate a pre-money valuation with the investor and you agree upon $6 million. If the investor puts in $2 million, your post-money valuation is 8 million. Okay. So that's pretty straightforward on the definition of pre-money valuation and post-money valuation. Okay. Unfortunately, most people get confused with the term pre and post money. There is a post money safe. Unfortunately, the post money safe has no correlation with post money valuation. People get them confused thinking that they're the same thing. They're not. Okay. The post money safe refers to a conversion method, the algorithm used to calculate how many shares the investor will have once the contract, the safe contract, is converted into equity. The post money valuation defines the company's worth. So conversion method is not company valuation, is not company worth. Post money safe, post money valuation, no correlation whatsoever. Okay. So how did these terms come to be? So if you look back at history, the use of convertible instruments, a convertible note was first used in the mid 1800s, believe it or not. It's actually not new. Okay. And Y Combinator created the safe and released it in December of 2013. After about 3.5 years of usage, people started noticing certain problems. Okay. And those problems were documented in a TechCrunch article released in July of 2017. So, because of some of the problems, which I'll get into in a moment, because of some of the problems, Y Combinator said, yeah, this is a problem. And they went ahead and created a new safe, which they called version 1.0. Okay. Clearly, these people, whoever created these templates and named them, were not software developers. They didn't do a version number on the original safe, the red safe there right in the middle. I guess that can be viewed as version 0.9 or whatever. But version 1.0 is what they call the new safe when it's not really version 1.0. It's substantively different. Okay. Instead of generically calling it safe version 1, safe version 0.9, whatever, that newly created variant of the safe ended up being called a post-money safe, okay, for various mathematical reasons, okay, which means the previous version becomes a pre-money safe. So again, December 2013, that was when the first safe was released. Then version 1.0 was September 2018. And if you remember from the slide all the way at the beginning, then there's other incremental changes. Version 1.1 was released in 2021 and 1.2 was released in 2023. Okay. But hopefully that helps illustrate the naming confusion here. Okay. Let me dig into the article a little bit. Why safe notes are not safe for entrepreneurs. Not my article. This was written by a VC with one of the TechCrunch staff. Okay. And a little side note here. The title, Safe Notes. That's the wrong name for a safe. Do not call it a safe note. Why? Why is it a big deal? There are actually tax implications to this. Okay. If you are an advanced and sophisticated investor and a good tax planner, what you call the contract is important. Most investors want QSBS treatment, and one of the tests for whether or not you would qualify for QSBS treatment will be the name of the contract. Okay. A note is a loan. Okay. The average person, probably 80% of people out there, refer to safes as safe notes. Notes are loans. Safes are not loans. What you call it will have a small effect on your tax treatment of the safe. Okay. So little sidebar there. All right. In the article from the author Pascal Levinson, he writes, safes have a nasty bite, much more dilution than the issuers thought. Okay. So how does that play out? It's very nasty math. Okay. And for the sake of simplicity, I won't go into the gory details. But let me at least illustrate the concept. So dilution in general is normal in a startup when they raise funds. Okay. But dilution is a zero-sum game. That means the amount of equity is always 100%. So if a new investor gets issued more stock, that means one or more existing shareholders will get diluted. Okay. So if someone goes up, someone else has to come down in their percentage of ownership. All right. How does dilution work with the original pre-money safe? So before the startup raises any funds, you have employees. They own all of the equity in the startup. Then a safe investor comes in and they sign a contract. It says, yes, here's my money, and I'll sign a pre-money safe. That results in pending dilution for the employees. Okay. Notice it's pending dilution because the safe is not equity today, it's equity tomorrow. Okay. Safe investor number two comes in and they sign another safe that results in pending dilution of the employees and any previous safe holder, who signed the earlier safe. Then safe investor number three comes in. They sign a safe and it results in pending dilution of employees and all previous investors. Okay. And then finally, a new equity investor comes in. Someone buys preferred stock that triggers the conversion of the safe into preferred stock, and that results in actual dilution now. So, how much dilution? Safe investor three conceptually gets diluted one time. Safe investor two gets diluted twice. Safe investor number one gets diluted three times, and employees get diluted four times. Conceptually, all new investors dilute existing stakeholders. Okay. It's a little bit more complicated than this, but conceptually, this is what's going on. Okay. Then, with a post-money safe, how does dilution work? Well, when before any money comes in, as similar to the pre-money safe, the employees own all the equity in the company. The first time the safe investor signs the safe, it results in pending dilution of the employees. No different. Okay. Second safe investor comes in, it results in pending dilution of just the employees. Okay. Third safe investor, pending dilution of, again, just the employees. Then the final preferred equity investor comes in, it results in actual dilution because it triggers the conversion of the three safes. It results in actual dilution of everybody, which basically means the safe investors one, two, and three get it diluted one time, and the employees get it diluted four times. The difference in the amount who gets diluted, again, when the new investors come in, somebody goes up, somebody has to come down because only the employees are getting diluted with a post-money safe. That's why employees get extra dilution. Okay. New investors with a post-money safe will primarily dilute the employees. Okay. This is actually a significant issue. If you love to read legal details, Jose Answer is a partner with Optimal Counsel. Jose writes an excellent legal blog in the startup space, and where he says, under YC's new safe, the common stock absorbs all dilution from any subsequent safe or convertible note rounds until an equity round, while safe holders are fully protected from that dilution. He says, that's crazy. Okay. Unfortunately, this dilution, once again, is not visible until much later when the conversion happens. And if you have a junior attorney who never actually spells out all the details, they just give you, here's your conversion math. You might never know that you got extra dilution. You just know that that was the dilution that you got. Okay. If you have a good startup advisor, somebody who understands the mechanics here, they'll actually model out the details of what the conversion will look like so you can make informed decisions before you sign a contract instead of like, oh, okay, I guess we signed it. We just have to live with it now. Okay. All right. So another quote from another person who's pretty prominent in the startup industry, Gordon Doherty, president of the Capital Factory, which is an accelerator down in Austin. He writes a book called Startup Success, and Gordon's quote is, I'd say after the 2018 safe templates provided by YC, the post-money safe, I would push hard on a startup and advise them to switch from a post-money safe to a convertible note. Okay, that's his perspective. All right. I don't completely agree with that because this quote was probably several years old and it may be a little bit dated because it's a little hard if the trend is so far down the road towards safes, trying to push back towards a convertible note may be difficult. Okay. And in fact, since Gordon made that quote, okay, the number of other funding options have come up, including a series first and a series safe. Series safe is different than a safe. Okay, unfortunately, they named it something with a very, very similar name. Okay. But they are different and they are priced equity rounds with very low lift. Okay. Very little effort compared to a traditional priced equity round. All right. Okay. So we have the extra dilution from a post-money safe, and then you have the pre-money safe. Well, what's the split between post-money safes versus pre-money safe usage? This chart here shows that the vast majority of safes that are being signed today are post-money safes. Only 12% of safes are pre-money in the conversion math. All right. In fact, that's not surprising because if you go to the Y Combinator website to try to download the safe, um, and you notice in the URL, the download only provides the post-money version now. Y Combinator has retired the pre-money version of the safe. Okay. All right. I apologize. I haven't covered a whole lot of questions because there's a lot of content. I'll try to catch questions at the end. Okay. All right. So, safe conversion to stock. This is a basic conceptual overview because this is actually a fairly advanced topic. Okay. If you want the advanced version, then I encourage you to read the Safe User Guide. It's a 32-page document, and 12 of those pages explains the process, the algorithm, and examples of how safes convert. It's not simple. Okay. Um, but let me at least illustrate it for you visually, conceptually. Okay. If a safe converts into shares for the investor, how many shares does the investor get? All right. Well, the formula works, the high level formula is pretty simple. You take the amount of money that the safe investor invested and you divide by the price per share. Okay, the safe price per share. Conceptually, founders want that safe price per share to be as high as possible because it results in the investor getting fewer shares, and investors want a low price per share so they can get more shares. All right. Well, what determines the price per share? That is determined by the dividing the valuation of the conversion by the company capitalization. Now it's getting a little complicated here. The safe conversion valuation is the lower of either the valuation cap or the priced round valuation less any discount. Okay, so the lower of the two. Right now, the most common is going to be the safe valuation cap. Okay. Then you have something a little weird where what is this company capitalization? Total number of shares obligated. What is that? Okay, and remember, the higher valuation on the numerator here, it helps founders. The higher capitalization on the denominator will help investors. All right. So what is this company capitalization? Okay. So if we take that little formula there, that company capitalization, remember, higher numbers, higher company capitalization number is better for investors. What is that? Well, it depends. It depends on whether you use a pre-money safe or a post-money safe. Because what you do is you count up number of shares or options that will eventually factor into that company capitalization. So both the pre-money and post-money safe includes the outstanding shares of capital stock and outstanding options. No difference. Okay, that's fine. Of course, there's also promised options. A lot of companies drag their feet in actually issuing the options. Maybe you hire somebody and they're granted options, but you never went through the board process to actually get them granted. That's a problem. You should grant it very quickly. There's tax reasons and there's all sorts of cleanup issues and stuff, but it happens often where people don't actually grant the promised options right away. There's also the unused option pool. All of this is included in the counting up the company capitalization. Where it starts to differ is down here at the bottom. Pre-money safe includes the option pool increase with the priced round. So many investors will ask that after the investment is done, that the stock option pool be topped off to 10%, 12%. 10% is probably the most common number. Okay. But because every startup issues a different number of options and there's no clarity on, there's no consistency on how many options are going to be issued. If the option pool has been depleted down to 4%, then when you top it off, you have to top it off to, depending on your dilution, top it off to 12%. And then after the preferred stock is issued, then it gets diluted back down to 10%. Okay, so you actually top off above the end target because after the round closes, it gets a little bit of dilution and then it settles at the 10% post funding target. That option pool increase is included in the math for the pre-money safe, but it is excluded on the post-money safe. That actually simplifies the math because this is an unknown variable. And I think Y Combinator wanted to simplify the math by excluding something unknown. Makes sense. Okay. But they also made another change. The safes, convertible notes, and other similar instruments are excluded from the pre-money math, but it's included in the post-money math. And remember how I talked about the amount of funds that the post-money safe and dilutes the the existing investors. It's this bottom row of the table that actually is how that materializes in real life. Okay, that bottom row results in a very challenging situation for most startup founders because that number can be quite material. Okay. So, safes, cap tables. Okay. Hopefully, everybody here understands a cap table, but if in case there's somebody who doesn't, a cap table is the authoritative ledger that shows the exact ownership of all company shareholders. It should include preferred stock, common stock, stock options, convertible securities like a convertible note and a safe, as well as warrants. It needs to be accurate, but it can be very, very complex. It needs to be clear so that people can look at it and quickly figure out what's going on. Should be complete, capturing all shareholders, and it needs lots of detail. There's a lot of data fields that need to be captured to have the cap table be correct. It also should cover and calculate fully diluted ownership, which is what the equity position, what the ownership stake, percentage stake would be if all possible agreements converted into stock. Okay. So that's the cap table. Why is it important? Well, most cap tables are wrong. That's the quote from Henry Ward, CEO of Carta. Let me give you an example. A while back, Bloomberg reported a software company called Tibco was acquired in a fairly significant $4.2 billion buyout. But there was a cap table mistake. Okay, it's $100 million mistake resulting in a lawsuit. Yes, the $4.2 billion acquisition, I guess, turned into a $4.1 billion acquisition. Okay. And if you get an acquisition that big, well, what's $100 million? I don't know about you, but $100 million is still material to me. All right. So the challenge is most startups use a spreadsheet to do a cap table and they just say name, number of shares, percent ownership. And that's it. They think they're done. That couldn't be further than the truth because every single line on such a spreadsheet needs to be backed up by the actual legal documents. And in the legal documents, it captures lots of little data points. All those little bullet points in, in that little graphic on the right, those are relevant to calculating ownership. And every time you issue stock, you have another one of these situations where you might have a stack of legal documents, all with different data points about, vesting start date, termination reason, blah, blah, all this other stuff. So it's a lot of documents, a lot of data. And people who track it only in a spreadsheet usually don't capture everything that's needed, which is why there's been a problem with cap table debt. And what it's very similar to technical debt. If you're a software engineer, you might know that technical debt is basically making a shortcut, okay? Because you're in a hurry and you allow certain problems to exist in the code because it's just faster. That generally results in technical debt, which as a good CTO, you're going to have to clean that up at some point. Well, cap tables have the exact same analogy where you have startup equity and you take shortcuts and you don't keep everything up to date. That also results in cap table debt. Types of cap table debt or things that cause the cap table debt. Things that I've seen over and over again. I've got 13 different individual problems here, which a lot of the times I take fractional roles. I'm cleaning up these 13 problems. Okay, and it's not easy. It's not like one of these bullets can be cleaned up in an hour. Sometimes it takes weeks for one of these bullets to be cleaned up. So I encourage people dump the spreadsheet, use a cap table product, cap table management software. Okay. If you've been to some of my other sessions, you know that I have a cap table tool. It's a spreadsheet, and it goes against what I just said. Okay. Why? Well, uh, I do believe that cap table software should be the system of record. All right. Um, and unfortunately, if you are a user of Carta, their reporting is hard to read. If you do an export, and this is actually a screenshot of an export of the convertibles ledger, it's a very wide spreadsheet. It doesn't tell you the type of safe, pre-money versus post-money. It doesn't actually list the val cap. Oh, yeah, it's actually there. You just have to scroll to the right. But that's one of the most important things you want to look at. So you might not see it right away. And it's also missing some key terms like does the investor have MFN or pro rata rights, which can affect a new investor might decide because those little key bullet points can affect my investment if I'm a new incoming investor. Even the detailed cap table export from Carta, there is no vesting data, and it's not clear how much of the detailed cap table is affected by the convertibles. Where is the fully diluted shares? It's just hard to read. And then, of course, it doesn't capture warrants. The Carta exports desperately need a UI UX redesign, okay, which is why I have my own cap table spreadsheet, which is really about readability. I use this all the time when I am playing a fractional role or when I'm an investor. I will ask the founders, hey, can you just take 30 minutes and put your cap table into this format because I can see everything at a glance. It's a nice dashboard for most investors. It captures common and preferred stock, RSAs, ISOs, NSOs, warrants, RSUs, all the different variants. It also estimates the fully diluted stake. It has up-to-date investing, which is one of the most important things that I look at when I look at an investing in a company. It breaks down the details of the option pool. It aggregates the stake of the stakeholders in case a certain founder or employee has had multiple grants. You want to be able to see what they hold in aggregate. Then it calculates outstanding and fully diluted shares, and it also takes into account an estimate of what the fully diluted stake will be if the convertibles convert. Okay. This is very important, but it's very rarely found. This cap table tool is included with my due diligence class. Okay. It's the due diligence class has 22 different tools. If you're interested, I will go ahead and post the details about the due diligence class in the chat window. I use these tools over and over and over again when I'm doing a fundraise or when I'm an investor asking founders to be able to provide the diligence content for me to evaluate. Okay. Um, Carta. There's been a couple of chat messages already about how Carta's got some tools here to help, and there is a safe automation tool. You can actually issue safes directly out of Carta, which is kind of nice, and they also have a safe calculator. Okay, safe automation tool basically asks you a bunch of details about what type of safe you're trying to issue, and they'll actually use the Y Combinator template or their own template, depending on what you choose, to be able to send the safe to the investor. There's a safe calculator. It can be used as a standalone tool, but it's better if you actually have your cap table up in Carta. It's a lot easier to be able to capture that. The safe calculator does some scenario modeling as well. Okay, so lots of content here. Why does this matter? I use the Carta safe calculator to build a situation where a startup has 12 safes. Okay. So remember, the average startup reaching their series seed round has 22 to 26 safes. So 12 is roughly about half of what the average has. And if all the safes are pre-money safes, then in this scenario, after the safes convert and after the round is raised, the founders keep 53.7% of the equity. Whereas with a post-money safe, the safe that gives founders more dilution, The same situation. The only thing that differs is pre-money versus post-money safe. In the situation on the right, founders keep 52.08%, which is a difference of 1.62%. So founders received 1.62%, or employees received 1.62% extra dilution. Well, how much is that in real dollars? So today and tomorrow. So if you run the calculation, I did it in a spreadsheet, okay? Um, Today, after you run, assuming you have a Series Seed, 1.62% is about $200,000 variance in this, given the terms of this fundraise here. Okay, but that's today. What about tomorrow? You're going to raise more funds in a Series A, Series B, Series C. Okay, so the Series Seed, $200,000 is the impact of the 1.62%. In the Series A, it grows to 340,000. Series B, in this scenario, these funding models, it grows to 446,000. And then if you have a Series C, then 590,000. You're now up to about $600,000 in extra dilution. Once that company gets acquired, let's assume it's a $200 million, $210 million acquisition. That 1.62% has now grown to a little over $1 million in extra dilution. Okay. So 1.62% adds up. All right. So let me cover a couple things, just finishing off some topics for completeness. There are several safe options. So it's not only is it pre-money and post-money, there's also four different types of safes. Okay, you have a discount safe where the conversion math is affected by a discount that you offer. It's usually 20%. So conceptually, how that works is that if the investor buys stock at a dollar a share, if you have a safe with a 20% discount, you would get your shares at 80 cents. Okay, pretty simple and straightforward. There's also a valuation cap that as the company grows in value, there's cap limits the math on the valuation of the company to convert the shares. Okay. There's also a discount plus valuation cap variant. Okay. But this version is no longer distributed by Y Combinator. And then there's another one called Most Favored Nation, where an earlier investor, if an early investor is followed by a later investor who got better terms, then the early investor gets the better terms from the later investor. Okay. So that's just to avoid, obviously, people getting an attitude about, hey, I invested early, but how come the person after me got a better deal? All right. So four different variants. How are they used? Okay. This is another card analytics where it shows the val cap and discount version is shrinking. The dark blue, the big bar on the left, that's the valuation cap only. So about two-thirds of the safes are val cap only. And even though 26% or about one quarter of safes are val cap plus discount, you see it shrinking from 40% in 2021 to 26% today. Okay. So if you look at again, the simple agreement for future equity, the template, in December, it was the pre-money safe, and they had the four versions available. Then in 2018, they updated it with the post-money safe, the version 1.0, also the same four version. But then came version 1.1, the val cap discount was removed from the documentation set. Then version 1.2 came up. They made a couple of more other legal changes. The val cap and discount was also is still no longer available. And then they also snuck in a little revision to the most favored nation version of the safe, and they called that version 1.3. So we have version 0.9 through 1.3. Okay. So availability, pre-money safe is not available from Y Combinator anymore, and the post-money safe is not available from Y Combinator. Oh, excuse me, not the post-money safe, the discount plus valuation cap. Sorry about that. I misspoke. Okay. So conceptually, of the four variants of the safe, most of them are ValCap version, or some of them, 26% still ValCap plus discount, which means 92% of safes have at least a valuation cap. 8% use the discount only, and less than 1% use the most favored nation version. Okay. There are other changes that happened in the zero point 0.9 pre-money safe as well to the post-money version. I already mentioned the founder dilution. There's more dilution now with post-money safe. The ownership math is more simple though. Okay. The general positioning, the pre-money safe was meant to be a bridge round, but today most of the safes are almost treated as if it's a standalone financing round, which means you're using a small tool that was meant to do one narrow thing, and you're now using it over and over again, which as you scale the usage, you don't always get the behavior that you were originally expecting. The pre-money safe is fading. Most people don't even know what it is anymore. The post-money safe is now well established, especially if you're in the Silicon Valley. There's also a lot of key low-level details that changed. A lot of legal terms in the post-money safe were cleaned up. Okay. And I summarized some of it here. Okay. I do apologize because I've tried to go fast because I knew this was going to cover a lot of detail, but it's already been too much. Okay. So I'm going to keep going and start wrapping up and try to address some of the questions towards the end here. So how does this all work? Who are all the players? What is it? How does it work out? Ultimately, founders are trying to raise funds. So your goal as a founder is preserve cash and preserve your equity by minimizing your cost and minimizing your dilution. Investors want to maximize their ROI by getting the best terms, both the valuation as well as legal terms. Remember, Y Combinator is an investor. They're one of the most profitable companies in the world. They make their money from investments. So keep that in mind when Y Combinator issues guidance, etc. They're very founder friendly in general, but ultimately they make their money as an investor. So founders, lawyers want to increase billable hours by advocating founders. Investors, lawyers want to increase billable hours by advocating for the investors. Where do we come into play? Fundable startups. Well, we sell premium training by proving premium value. Okay, lots of training out there. Very few of it, if you've paid attention, I don't think very many other training classes go to this level of detail. Okay, Carta is involved here because they want to increase their subscribers by automating deals and providing tools where everybody just uses Carta, right? So follow the money. Why are people doing what they're doing? So what's the takeaway? Okay. Am I saying post-money safes are evil because they increase founder dilution? Okay. Should you demand a pre-money safe? Well, I don't think so. I'm not trying to say that. What I am trying to highlight, though, it's about your attractiveness and your leverage. Okay. Who is the preferable date? Frankenstein on the left, or somebody who looks like they've got their life together on the right. Okay. And when you are more attractive, you are able to actually have more influence. I'm going to skip some of this content here because I want to go towards the end here. So why do people use safes? Okay, if you have a choice between the apple and the donut, well, I'm sorry, I love donuts. Okay, they're fast, they're easy, they're cheap, they defer the valuation, they taste good, etc. Okay. Um, but that also involves a number of trade-offs. Okay. Fast, easy, cheap, that tips the scale, and the deferred valuation, that tips the scale in one direction. But if there's a cost on the other side, there's cap table clarity problems, there's taxation risks with QSBS, which is a huge deal if you're an investor and if you're a founder too, actually. There's extra founder dilution, and then there's a challenge of the zombie safes. Okay. I think, unfortunately, in the same quote from post from Peter Walker, he talks about how different investors have different levels of sophistication, okay, and or fund or economic strategies, okay. Most people just want to get the deal done, which is why they use a safe because it's quick and easy. But in the landscape of the funding vehicles, early stage funding vehicles, if you look at the complexity of terms on the vertical axis and the certainty of the equity on the horizontal axis, that equity certainty is questions like how close is this transaction to a stock sale, which is important for QSBS, and how much equity was sold so that all right, how much equity you have left. Okay. So that naturally provides a 2 by 2 matrix. A convertible note is roughly, my opinion, right there on the center left. A pre-money safe is in the upper left corner. A post-money safe is kind of top Then you have your Series A financing round, which is usually done with NVCA model documents. That's 200 pages worth of legal contracts. This is a very heavy lift because it's so much legal work. Another attorney, Ted Wang over at Fenwick, used to be at Fenwick. He created a lighter weight version called a Series Seed model contract. And then there's several other attorneys who created even lighter weight versions. I've had two webinars, one on the Series Safe, one on the Series First, from the attorneys who've actually gone through that. And conceptually, if you drew a line, a path through these various instruments, this is the pathway, the general journey. Okay. Uh, if you can get in the upper right-hand corner, especially since that results in preferred stock sale, like Peter Walker talks about, then I think you're in a better spot. The numbers in each of the circles is the number of pages in the model document template. So as you can guess, the more pages, probably the more complex it's going to be. Okay. So safe trends, dilution impact, to summarize. Almost all safes today are post-money safes. Okay. That means that founders will absorb more dilution when they sign safes. In addition, startups are starting to sign 20 or more safes before the priced round, which the impact is stacking all these safes will increase your founder dilution and make it even more difficult to calculate. Remember that illustration with the 1.62%, that was 12 safes. So if the stacking 20 plus safes comes into play, you might have more than 1 or 2% of extra dilution. Okay. The total value of funds being raised on safes is growing. And it used to be anything over $2 million raise was usually a priced round. Now it's getting to be $3 and $4 million raises are still being done on safes before a priced round is done, which increases your founder dilution again. In the past, founders rarely had to build pro formas to be able to see the safe dilution, because if you just do one or two or three safes, maybe it's not that big of a deal. But once you're stacking 10, 20 safes on top, you really need to be able to build that pro forma calculation to avoid being surprised when the price round happens. So where does that lead us with our startup training? Okay. So this has been a lot of content. I apologize for overwhelming you, but I did warn you at the beginning. It's a lot of content. Why do we do what we do? Why do we build our training? One is that we have why do we think our training is different? Okay. We have a structured journey to fundability. Okay. We have a startup roadmap and a blueprint. Most startup training, just random content with no specific journey. Okay. I am a engineer, so that means methodology and process is important. That structured journey is my process, and I tie that into the how I built the training. I also have lots of experience as a seasoned operator. I've been a CEO once, a CTO once, and a technical VP three times. I've gone through four acquisitions, as an employee, four acquisitions, and seen two shutdowns. I actually learned more from the companies that shut down than the companies that got acquired. Most people in the startup space, a lot of them got lucky one time, but can they really repeat that level of success? Don't know. Okay. The other aspect that you've seen clearly from this session is I have a lot of deep dive content. I'm not a fan of 1 minute sound bites. There's actually somebody out there who talks about 1 minute business tips. In the startup space, you might learn an interesting sound bite, but it's usually not transformative. Startups are hard, and it takes a lot more than a 1 minute little sound bite to be able to make an impact. You can also see that a lot of our content is very visual. Lots of other third-party training is very, very dull and reads like the dictionary. This stuff is hard, and when you're reading bullet points on slides, your eyes start to get cross-eyed. At least mine do. Okay. And then in addition, a lot of the training I have includes ready-to-use templates. Remember that due diligence class includes 22 tools and templates. So the class teaches a best practice, then the template and the tool gives you the framework to be able to implement the best practice. Most other training doesn't have any such templates. So I have a process. Again, I'm a process person. 5 steps to raise pre-seed funds: prepare, plan, execute, sell, and close. I have other training that covers this. It's about building fundability before you try to fundraise. And fundamentally, our training aligns with that process. So these are examples of the training classes in my training program. I've got a ton of testimonials from folks who've gone through the training. This one here from one party said that one customer, one founder actually said, that was the most efficient breakdown of a complex topic I've seen in all my fumbling around with different startup content. Okay. I even have an attorney who actually recommends my training to a lot of his clients because he actually states the training videos can save his clients a ton of money. So this will be my last slide. I'll stay a little bit longer to take some questions, but fundamentally, if you want access to the training, the QR code on the left will give you a 20% discount on the entire training package. Let me go ahead. If your QR code does not scan for some reason, this is the clickable link in the chat for the premium training. Or if you're not, if you may not be a fan of online training. Again, I tried to make it very engaging and very visual and interactive, but if that's not your cup of tea, that's okay. You can still book a coaching session on my calendar if you'd like some more detail. I know this was a lot of information, but this is how complex the startup stuff is, and it gets deeper and deeper and deeper. Okay. So I'm going to go ahead and start to go through some of the questions in the QA. I'll thank you again for staying late. I apologize for going long. Let's see. Let me back up here. Do, 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 do. Right. Okay, so there's a question. If you still want to use the pre-money safe, are there good alternatives to the original YC version? And the answer is yes. If you go to a seasoned startup attorney, they probably have the pre-money safe template saved on their computer somewhere. I have it as well. In addition, Carta, with their safe automation, they will allow you to choose a pre-money safe if you choose to use their template. Their template is somewhat different from the Y Combinator version. And the one challenge is if you use the Carta version, then some investors might slow down the fundraise process because they're like, what is this? I got to read all the detail and the legal language. Okay. Um, let's see here. Uh, Okay, so there's chatter about using potentially a pre-money safe and et cetera. I would encourage you, if you are interested, to if you're concerned about the extra dilution, um, uh, consider some of the other instruments here, the Series Safe, the Series First. You can reach out to me, happy to connect you. If we did a coaching call, I can kind of give you my best perspective on where you're at, what options might fit best for you before you start spending money with an attorney. Okay. Um, so the other thing I would say is that make sure you don't overcompensate on the dilution issue. And what I mean is this. If your investor says, I will only do a post-money safe, don't pound the table and say, you as a founder will only sign a pre-money safe unless you are way oversubscribed, like investors are beating down your door to invest in you, you might have to just absorb the extra dilution and just, hey, that's the cost of doing business, okay? Um, don't kill a deal just to save 1 point of dilution. However, what I do want to say is make sure you know what you're getting into. If you choose to accept the extra dilution, do that with both eyes open. Do that knowing how much that's going to affect you, so that if you know you're going to take extra dilution, then that may change how fast you spend your money or how aggressively you seek the next round. Okay. Okay, if pre-seed is difficult to nail the valuation with angels, what is the alternative to safes? How do you do a priced round so early? Oh, okay. Very good question from Noel. Yes, pre-seed, yes, is very difficult to be able to visualize the dilution. And that's where this particular slide here, the series safe or the series first, may be of interest to you. Okay. I was actually working on a price round I was going to lead a price round with a startup that came through Band of Angels. Um, it was probably going to be around $1 million round, and it didn't make sense for us to do the NVCA docs. So that's one of the reasons why I, looked into the Series Safe or the Series First because they are much lighter weight. Side note on that particular startup, ended up not investing, or excuse me, the investment was put on hold because we found tons of issues with their diligence. Okay. Um, Remember that due diligence class that I highlighted earlier? That is one of the classes that's included in the premium training pack. The premium training pack is $1,000 with a 20% discount, it's 800 roughly. But if you only want to get access to that due diligence class by itself, then you can buy it a la carte. Okay, it's in the chat window. All right. Okay. Given we are pre-go live stage with only an MVP, which fundraising is most important between safe, convertible, no price open is recommended equity allocation valuation cap range for founders to consider at this stage. Okay. A fairly detailed question from somebody says that they've only gotten their startup to an MVP stage. What instrument is best? Okay. And the answer is it depends on your situation. It depends on what you want to do with the company. It depends on how much you've de-risked the startup. Now, I talked a lot about building a fundable company before you fundraise, and it really comes down to that. Um, in general, if I was doing this from day one, if I'm doing some very small fundraisers of $25,000 or so, then I'd probably just path of least resistance, do a safe, post money safe. Okay. The small dollar amount does, if, even though it increases your dilution, because the safe dollar amount is only $25,000, you were talking about 0.02% or 0.04% or whatever, depends on the terms and conditions and stuff. It's not a big hit. Okay. It's when you start getting larger dollar amounts and you start raising many, many safes, that's when the dilution starts to bite you. Okay. So to get started, to get quick, to get things done quickly, probably do a post money safe. But once you start raising, more than $500,000 or so, you may want to consider, or even once you raise more than 100,000, you may want to consider doing the Series Safe or the Series First in the upper right-hand corner of this 2x2 matrix. All right. But again, it all comes down on a situation by situation basis. Okay. And if I had a chance to dig into the details of your situation, I might have a different opinion. Okay. All right. Okay. Question, what percentage of raises are pre-revenue nowadays? I don't have a good stat on that, unfortunately, Wade. But I would say that no, that more and more startups that raise are post-revenue, unless they're in certain industries like hard tech or pharma or whatever, where revenue is, 5 to 10 years out down the road. Most companies More and more companies are starting to have revenue in order to justify a reasonable valuation on the raise. Okay. Uh, Again, certain industries can be exceptions. AI is hot, just about, back in the early 2000s, anything .com got funding. Today, anything .ai seems to get funding. All right. Let's see. From a founder point of view, invest to sell investors common stock rather than preferred, assuming you can find some investors who agree with this. So this is a more straightforward question. Should a founder, is it better to sell common stock? Okay. And in most cases, the answer is generally no. Okay. Um, Professional, sophisticated investors do not want common stock. Okay. It does not give them rights and privileges, which is going to be important for them if they're going to be involved in helping the add value to the company. Preferred stock will give them more rights and privileges that they seek. Okay. The other concern about selling common stock is that that sets your fair market value. Okay. And that's the entire 409A question, where in most cases, it's preferable for a startup to try to keep the common stock share price low for as long as they can. But the moment you sell common stock, again, as a founder perspective, when you sell stock, you want that stock price to be as high as possible. So you dilute yourself as little as possible. So you have a tension here of if you sell common stock, you want for the purpose of this transaction sale, you want the common stock price to be high, but for the purpose of equity and stock option strike price, you want it low. So selling common stock goes against the general goals. Okay. All right. We talk about roll vehicles with small checks. I think I'm doing a side letter with our safes to give us rights to move small checks to a future roll-up vehicle. Okay. There's a question here about what to do if you have lots of small checks, lots of 10, $20,000 checks, whatever. You can do a roll-up vehicle to be able to aggregate that, but it's more work. Okay. There are third-party websites that will help you with that, and you have to pay a fee pretty much perpetually until the end of time, until that roll-up vehicle goes, the need for that goes away, which can be years and years down the road. Okay. Um, so you could do that. I generally don't see individual startups going down that path, even though there may be some value. From a Band of Angels perspective, the band has 150 members, and let's say 10 of the members want to write a check to a company that pitched. To avoid getting 10 individual checks, the band already has a roll-up vehicle. So we will do that for you. It's no cost to the founder. Okay. All right. We're good for that. It was funny. Okay. I think there's a repeat of the question I just answered. All right. I don't see any other questions. Thank you very much for staying long, and hopefully this was useful. Do consider some of the training because we put a lot of time and effort into it. We try to capture as much value as possible in the training, because my coaching hours are much shorter supply and much more expensive. Okay. So since the training has the 30-day money back guarantee, it's really we try to make it a very low risk proposition for people to invest in the training. And if you buy the training course, training package, and you want some direction on which classes to start with, I'd be happy to do a quick initial consultation to kind of point you in the right direction and say, go to this class first, this class next, etc., based on what you've told me about your startup. Okay. Consist dollar ranges for series safe, series first, safe preferred. Okay, so if you choose to do a one of the new emerging priced rounds with a series safe, a series first, or a series safe preferred dollar ranges, yeah, you could do it as for as little as maybe $25,000. There is potentially a small legal cost could be thousand or so dollars or so. So that's why you probably don't want to do it for a micro investment of under 10K. Okay. But once you're hitting around to the $25,000 range, it can make sense. Um, so probably the best thing to do is if you want more detail about the rhythm and flow, maybe we could just do a quick coaching call. Okay. And yes, I do plan to record the webinar. My one of my team members is off on vacation, so it might take me a little while to get it up on YouTube, but I do plan to post this up on YouTube. Okay. Thank you much. Sorry for the overwhelming flow of information, but hopefully you were able to retain some of it. Okay. Thank you. Bye.
If this was helpful, please like this video and subscribe to our channel. You can also check out our other videos for more startup content.